Hello and welcome everybody to this particular episode. And today I just want us to look at why retail traders always enter too early. This is the second topic we are doing under the CMC, Smart Money Concept, stroke ICT concept. And the key reason is to understand the timing in Forex trading because, like I said, I've been focusing on structure. My theme has been, all my videos have been rotating into three themes: structure, liquidity, and time. So this video is specifically looking at time, that the aspect of time. And this is the Forex education series under the Team Forex Traders launch. And let's dive into what we have into this. So the core problem, why you realize that traders always enter too early, is that they often identify the correct market direction, but they still lose the trade. So the issue is usually not analysis, it is all about time, okay? Because what you need to understand is that as a trader, they'll be able to see the level. Also, they'll be able to anticipate the move. Then now they enter. And price moves slightly further against you before doing exactly what you predicted, right? So I believe that is something that looks familiar. So actually, that is not really bad analysis, but that's early timing, okay? That's what you can call early timing. So under this video specifically, for traders who identify the right direction but still lose trades, feel like the market moves only after stopping them out, and also they enter before confirmation or struggle with patience at key levels. So if you are often right about direction but wrong about timing, therefore this video is for you, or it will help you fix the framework. Okay, so so you need also to understand some of the common experiences, like I just mentioned. You identify a key level, you enter the trade, then price moves slightly against you, and your stops get hit. So the price then moves exactly where you had expected. I believe this is a common experience to you as you are listening to this particular video. This is a common scenario that you have always witnessed in the financial markets. Okay, so and the psychological cause is because traders they enter the trades due to FOMO, right? The fear of missing out. So that is FOMO. Also, we have impatient, and also the desire for the perfect entry, plus emotional pressure to act. This is all the psychological cause that makes traders enter the trades too early. Okay, so because it's all about psychology. Remember, we have said that forex trading is 80% psychology, and therefore entering trades early is rarely about strategy. It's all about psychology, because traders fear missing the move, watching the price run without them, or probably being late. So what they do is that they enter the first sign of potential movement, and this feels proactive, but it's usually premature entries, and the market rewards the patient, not anticipation, because you have to be patient to it for the market to come to your point of interest. Okay, so and what you need to understand is that why early entries become liquidity. Okay, early entries create liquidities. Why? Because you realize that early entries, or when traders enter early, they place stops in predictable locations. Okay, for example, below support, above resistance, inside consolidation, and those stops become liquidity. All right, they are the ones that becomes liquidity targets. And if you understand liquidity, because I've always done videos on liquidity, is that liquidity attracts the price. So when the price dips slightly below your levels before moving up or down, depending on the kind of setup, so it's often collecting the very stops created by the early entries, and the move still happens just after a weak hand exists. Okay, so you have to really understand structure, liquidity, and time. Okay, so how the market makers use liquidity, you realize that the price often moves towards clusters of stop loss. This allows large participant to fill in the bigger orders, and therefore liquidity fuels a market movement. Also, you can refer to the last video I posted. I have embedded it into this particular video, so you can check it out. and you will realize, you will be able to understand more about the liquidity concept. Okay, so there is a difference between a prediction versus confirmation. So when you're talking about prediction, basically prediction says that the price will reverse here, but confirmation says, okay, price has started reversing. So what retail traders prefer, they prefer prediction because it offers early entries and bigger reward potentials. But prediction, what it does is that it increases uncertainty. So confirmation helps sacrifice some reward, but dramatically it improves your probability. So the goal is not to catch the exact turning point, but it's to catch the move with evidence. The reason why we are saying confirmation, waiting for the evidence of reversal. Okay, so you have to differentiate between confirmation and prediction. Prediction is whereby you are expecting the price to reverse at that particular level, but now after predicting, you have to wait for confirmation. For you wait for the evidence of reversal, change of character, shift in market structure, right? Because professional traders, they prioritize confirmation more than prediction. Okay, they prioritize confirmation more than prediction, right? So, and the role, when you talk about the role of liquidity sweeps, because it's very important to understand, okay, the role of liquidity sweeps here. So you need to understand that one of the main reasons why traders get stopped out early is liquidity sweeps. So before reversing, price often breaks obvious levels, right, or a key level, triggers the stops, right, traps breakout traders, and then it moves into the expected direction. So this does not actually mean that your idea was wrong. What it means is that your timing was early, and waiting for the sweep and confirmation keeps you aligned with stronger entries, so that you don't so that you avoid taking those premature entries or early entries. Okay, so and how to avoid entering the trade too early. So you have to wait, look, trade, and accept. Okay, so I'm going to give you four ways to avoid entering the trades too early, right? So the first one is wait. And what are we waiting? We are waiting for liquidity to be swept. So if obvious stops exist, expect them to be cleared. Then you have to look. What are you looking for? You are looking for structural confirmation. You wait for minor structure breaks or displacement or structure shifts, right? Then now you trade. That is use session timing. That is trade during active sessions. High probability moves occur during London and New York, not just random. And again, they can occur even in the Asian session, depending on which asset you're trading. Then number four, you have to accept. Okay, so you have to accept that you will miss some trades. So accept missing some moves. You don't need every trade, you don't need every move, you need the right ones. So patience help reduce losses more than precision ever will. Okay, so and why I'm sharing this content is because you realize that initially, maybe sharing from my own perspective, I used to think that maybe probably getting the earliest entry meant that I was being skilled. But just like we talked about the common situation, you enter, I used to enter, the price retraces, and of course, you enter early with the aspect of greed. Once the market retraces, then it could really damage my account. I could really make a lot of losses. I ended up sometimes even blowing accounts. So, but what I eventually realized through my learning journey is that I was simply providing liquidity for better timed traders. And once now I understood the concept of liquidity, the concept of time, the structure, I think my trading improved, right? Stop outs dropped dramatically. Okay, so and the reason why from these now I can be able to derive some key lessons from this particular video, that the goal is not to watch, the goal is not to catch the exact turning point, but the goal is to enter when probability is higher. That's why I always talk about high probability setup. You have to be patient to wait for the high probability setup. Remember, as we conclude, direction matters, timing matters more. Patience and confirmation reduces losses. Okay, so retail traders, they enter early because of fear of missing out, anticipation, impatient, lack of confirmation. But professional trader, they wait for liquidity sweeps, structural evidence, session alignment, and a clear movement shift. So direction really matters a lot. Okay, timing matters more. So as a trader, therefore, for you to align direction, time, right? Direction here represents structure, time, liquidity. So you have to build patience and wait for confirmation so that you can be able to reduce unnecessary losses. All right. So in the next video, I'll be breaking down liquidity, or in terms of the real reasons why stops get hunted. Because once you understand how liquidity works, many confusing market movements suddenly makes sense to you. So until the next one, keep safe.